In today's video, I want to look at the stock markets. They continue to get more and more dangerous, in my opinion. I've got the 200-day moving average here. I'll take a look at a couple of charts. You can see when price starts to get too far above the long-term moving averages, usually you get some kind of a corrective move that'll come back down to or close to it. If the intermediate cycle ends up being extremely right translated, then you can often get a crash simply because it just runs out of time for the correction. Normal correction should last 4 to 6 weeks, but if the government props the market up too long and prevents the correction, allows price to stretch too far above the long-term moving averages, then the correction has to unfold very rapidly at the very end of the cycle. And I think that's what we're getting into right now. Is the last clear intermediate cycle low was back here in June. As I said for a week or two now, the government would prop the market up ahead of the holiday buying season. They wouldn't allow any kind of correction to disturb holiday spending. That's what we're getting, and unfortunately, I think it's going to cause some kind of a crash event early next year in January or early February. And you can see there's just a lot of space between price and the 200-day moving average, and you can just look back at history and see what typically happens when price gets stretched too far from the long-term average. Is usually you'll have some kind of a correction that will a profit-taking event that will snowball, and then you'll get back down towards this average. We're starting to hear a lot of melt-up talk in the media now, and if I thought we were at the end of this bull market, then I would agree with the melt-up. I would say we're getting ready to transition into a bubble phase for the next year, but I think this bull market still has another 10 years to go, so I think it's too early for an actual melt-up. So I suspect we're going to get a serious correction here soon. Like I said, in January, February, and we're going to come back down to test this breakout zone, maybe back down around 8,000 or so, somewhere in here before we get the next leg up. And if I convert this to a weekly chart, you can see it's even more extreme. You can see what happened when price got way too far above the 200-week moving average here. We had a major crash. I think we're setting up for one. I'm still kind of up in the air as to whether or not this was a 4-year cycle low. And let me switch this over to the S&P. It came a little too early. This wasn't even 3 years yet since this last 4-year cycle low. It did test the 200-week moving average, and that will often happen during a 4-year cycle low. But the normal timing band for that would be early 2020, and we've got problems in the financial markets brewing, although everyone seems to want to ignore it. But the Fed has been pumping billions into the repo market for a couple of months now. It's not healing. They're still having to continue to pump liquidity into that market. So I think we've got the catalyst for another severe correction early next year. And the longer the plunge protection team props this market up and prevents the correction, the more they allow price to stretch away from these long-term moving averages, the more severe the correction is likely to be. And then here is the semiconductors. That's the leading sector of this bull market. And you can see the stretch above the 200-week moving average has just gotten to be absolutely ridiculous and absurd at this point. Price is going to have to come back down and close some of this gap. So fight the urge to think that this isn't all clear to just jump into the stock market when we're this late into an intermediate cycle and everybody is becoming bullish, when there's just you can't find any reason at all to be bearish. That is when a profit-taking event starts, and this is not going to be, I'm not looking for a top in the bull market, although we will certainly see the usual perma bears start calling a top again when we do have a correction. We just need a profit-taking event. The market needs to cool off a little bit. Smart money will start to take profits here at some point, and then that will kind of snowball. And as I said, these extreme right translated cycles, usually what happens is everybody quits hedging, and then smart money starts to kind of dance close to the door. And as they start to take profits, the correction will start. The market will start to go down, and then at some point, everybody tries to get out the door at the same time, because you've got a lot of people that bought late in this rally, and once their position becomes negative, they stop out, and so you just get a big wave of selling, all piles into the market all at once, and that's what causes these crashes. And the ultimate setup is that the powers that be, the plunge protection team, they don't allow the market to behave naturally, so we don't get a natural correction, which would occur over the space of 4 to 6 weeks. They push the market way too far above the moving averages, and then you end up with a crash at the end. I think that's what we're setting up for early in 2020, is I think we're going to have some kind of a crash event, and it may actually turn out that could be the 4-year cycle low, rather than what occurred last December. This, as I said, this was a bit early for a 4-year cycle low, so I'm not completely convinced that we've got our 4-year cycle low. It may still be ahead of us, and considering how far price is stretched above the moving averages, I think we're set up for some kind of very scary profit-taking event early next year.